Hey guys, in today's video, we'll be going over the Builder's Guide to Accounting. If you don't already have your book out, make sure to pull it out. If you have any questions about the highlighting guide, please click the link down below. And I have a whole entire course going over the Builder's Guide to Accounting, Contractor's Manual, AIA documents, so you can pass your business and finance exam on the first try. It also includes practice exams as well, over 10 practice exams, and over 1,000 questions in the question bank for the practice exam. So every time you take a practice exam, it's a different question. If you're also struggling with the math for Builder's Guide to Accounting, there's over a 40-minute video going over all the math you need to know for the Builder's Guide to Accounting. If you guys also want to join the free WhatsApp group, the number right here, text it right there. I'll add you to the group. It's everyone talking about the exam for business and finance. And if you have any questions, you can also message me on that number as well. Also, a freebie for you guys. There is a free practice exam for the Builder's Guide to Accounting. If you use the link down below, put your email and I'll send you a free practice exam so you guys can test how you guys are doing on this specific book, Builder's Guide to Accounting. So yeah, let's get into it. I didn't have anything on page 1. Is going to be reducing your costs will achieve maximum efficiency is the goal of well-designed bookkeeping system. So the records you need. But if you can make good use of the financial information in your books, you'll be a more informed manager. The more insight you develop, the more effectively you become. The sales journal. The sales journal is a detailed record of all your income from operations. You need this detail for financial statements. It also provides a good way for you to see how you're doing compared to last year, last month, or last week. The comparison of income to past performance is very important to you in planning. Good sales records are also helpful in finding the right market for your services. Because there are so many different kinds of contracting markets, you must know which ones will let you compete most profitably. Okay. Naturally, you need to know who owes you money. Your method of keeping track of receivables is important to the accuracy of your billings, your collections, bad debts, and financial statements. Many builders run into their single largest bookkeeping problem when it comes to keeping track of receivables. So they might ask you on the test, what is a builder's single largest bookkeeping problem? And it's keeping track of receivables right there. The check register is a listing of all checks with expenses broken down into categories. It's important to write up this record each month or even better each week. Bank accounts. Also, if you guys have noticed, I am here wearing a wedding band now. I did get married. It's kind of the reason I took a break for so long. So yeah, now I am married. Don't depend on your bank to keep your checkbook straightened out. Balance your bank account every month to be sure how much cash you really have. Once again, balance your bank account every month to be sure how much cash you really have. Cash on hand. Most builders need a cash fund for the little expenses that come up from day to day. COD deliveries, postage due, coffee and donuts, and newspaper expenses too small to write out a check for. Setting up a controlled petty cash fund is the best way to control these disbursements. In a petty cash system, you vouch for all expenses by replacing cash removed with a slip of paper, a voucher. That explains the reason for the expenses or list an account number and gives the amount. Your records should let you calculate the hourly cost of owning and operating your equipment. That's equipment records right here. Okay, overhead expenses. The fixed necessary expenses of being in business are often considered to be uncontrollable. Your record of past overhead expense is the best indication of what you can expect in the future. If they ask you your overhead expense, how do you indicate your overhead expense? Your record of past overhead expenses is the best indication of what you can expect in the future. So it's your past record of your overhead expenses. A good budget for overhead expenses will serve as an important guideline for month-to-month planning. Accruals. Accruals is very important. You need to know what accruals is. In the course, I go more in depth in what accruals are and explain what it means better. So if you need help on this, once again, join the course. Bills you've sent out are income, even before the cash comes in. And the bills you owe are direct cost or operating expenses, even before you mail the checks. These are called accruals. The chart of accounts is a numbered list of the accounts on your general ledger and operating statement. Ratio. These ratios show month-to-month trend of your business. These trends are useful in revealing financial statements themselves. For instance, a statement that compares this year's performance to last year is valuable for finding out whether your management skills are producing profits and whether your financial health is improving or declining. Okay, double entry bookkeeping. Very, 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 very important. The most common modern bookkeeping method is called double entry bookkeeping. This is, I think, a question everyone gets on the test. They'll ask you, what is the most common modern bookkeeping method? And it's double entry bookkeeping. This is something I go over in the course showing you, hey, this is most likely going to be on the test. I try to go in the course giving you all the information as fast as possible so you don't have to watch thousands of videos. It's just like, here you go, here's all the information. This is all you need to go pass the test. Double entry bookkeeping is so called because every transaction requires 2 entries. Once again, double entry bookkeeping is so called because every transaction requires 2 entries. A debit is an entry made to the left side of an account, and a credit is an entry made to the right side account. This is very important, understanding what debit and credits are. Debit balance pluses and credit balance is minuses. Very important. I go over this as well in the course so you can understand this. That is very important as well. It's kind of a cheat sheet. All right, the debit increases in expense count and decreases the balance of cash. All entries to the general ledger, the record that summarizes all business operations. Figure 1.1 shows the traditional ledger page. Debits are posted on the left side and credits on the right side. Figure 1.2 shows the results of posting to a single general ledger account from several sources. The T account, so named because of the letter T, created by lines, is used here to demonstrate this. The T account is a simple way of separating debits and credits on a worksheet. The financial statements are reports which express information summarized from the general ledger. The balance sheet is one of 3 financial statements. It's a listing of properties, assets, debits, and liabilities, and ownership value, net worth. The term balance refers to, and right here, very, very important ratio. I go over this in the course as well. You got to know this ratio. And also there's different ways this ratio is written that they don't show in the book that you need to know as well. The income statement. List of income, directs, costs, operating expenses, and profits. While the balance sheet lists the balance in assets, liabilities, and net worth accounts as of a specific date, the income statement reports the results of operations within a defined period. All right, the statements of cash flows. Last year's income paired to this year's will reveal the good and bad trends in the business and the increase of decrease in volume, expenses, and profits. Okay, let's get into chapter 2, accounting methods. So the way you treat sales and recognize the income they generate is the foundation of any accounting system you adopt. The decision about when to book income creates problems for both the builder and the accountant. There are 2 accepted ways to record income, the percentage of completion method and the completed contract method. So that's a really important line right there. If they ask you what are the 2 accepted ways to record income, it's the percentage of completion and the completed contract method. We'll go over percentage of completion and completed contract method in this chapter as well. But contractors sometimes receive payments for work not yet performed or only partially completed. The portion of income above the degree of completion is said to be unearned in the accounting sense. It is not earned and should not be recorded as income until the work is completed. When you receive cash for work that's only partially complete, you have to separate out the unearned part of income and assign it to a special account. This is known as percentage of completion accounting. So right here's an example of percentage of completion. In the course, I go over this more in depth. Okay. Accountants handle situations like this by deferring the unearned income. Right here is an example as well. The following shows an accrual of unearned income. I go over this in the course as well. Most contractors and builders use the percentage of completion method for recording income. It's the only acceptable method for builders who have fairly large jobs in progress. Under percentage of completion accounting, your books reflect the effect of receiving payment either or after it's earned. Retainage serves 2 purposes. First, they serve to guarantee against unforeseeable problems with final completion of a project. The advantage of percentage of completion. This is important. You have to know the advantage of percentage of completion. Right here is the income and its related costs, expenses, and profits are recognized and reported as the job progress. The term recognized refers to the accounting treatment of an amount. The disadvantage of the percentage of completion, and then read the disadvantages. And then right here is the money ratio. This is a very important ratio right here. Find the current percentage of completion by adding the total cost to date. So in the course, I go over how to use this ratio, and also they'll have questions that you have to figure out how to get the numbers to plug into this ratio. As simple as people make it seem, they're not going to be like, here's the cost to date, here's the estimated remaining cost of completion. They're going to make you work for that. They'll make you do math to actually get the cost to date and estimated remaining cost of completion. That's what I go over in my course. I show you examples of what are questions that they could give you on the test regarding percentage of completion, and I show you how to do the math to get the percentage of completion. Recognizing income by the completed contract accounting method has the advantage of exactness. There is no need to estimate the degree of completion because all income is recognized only when the job is 100% finished. You know what's weird? In the contractor's manual, if you read completed contract method in chapter 3, it says that completed contract method is recognized when you're like 98% complete. And here it says 100%. So there is difference between the contractor manual and the builder's guide to accounting. It's a little weird. This method is almost always used for small jobs, one-time work, material sales, isolated minor contracts, and other job of short duration. You can only use completed contract accounting only when you complete a job within 2 years from a contract date, and only if your annual gross receipts are under 10 million. There are 3 major disadvantages of the completed contract method, and then they go over the 3 right here as well. Okay, moving on. A small builder specializing in residential repair work can use the completed contract method because nearly all work is of short duration. But if the type of work he performed begins to include larger duration jobs, he may have a good reason to adopt the percentage of completion method. Like many contractors, you'll probably want to use the percentage of completion method for long duration contracts and keep shorter jobs on a completed contract basis. Under percentage of completion accounting, all retainages are accrued income. Any prepaid income must be deferred. This is important right here. The unearned income accounts are assets. All right. Figure 2, might want to read that. That as well. Okay. Moving on. So asset accounts, liability accounts, income accounts. The accrual system is by far the most accurate. As an alternative to the accrual system, you can also keep your books on the cash method. The advantage to cash accounting is its simplicity. All right, and that is it for chapter 2. Okay, let's get into chapter 3, cash and charge sales. Cash sales are payments you receive for work or a product. Charge sales are all sales you made on credit and for which you will issue monthly statements of charges. Receipts are posted in 2 ways. If you're keeping your books on the accrual system, income goes in the books when earned. The debit is made to the assets account called accounts receivable, and the credit is made to income. Later, when your customers makes a payment, the debit goes to cash and the credit, it goes to accounts receivable. Your entries should look like this. It's a good example here. Recording cash sales. List your cash sales by date so you can create summaries for general ledger entries. If you do any work on credit, you have to use an accounting method that records both cash and charge sales. Nothing on there. Okay, this is one of the important things that is in this chapter right here. It says, most builders allow a 2% discount to certain types of trade accounts, only rarely to all customers. 99% chance this will be on your test, so make sure to have that saved. The real value of a good receivables method is in the variety of information it provides. Invoices should show enough detail so your customer can identify the materials and service and pay according to your terms. Tracking receivables. If retainages or similar withheld amounts become a major part of your receivables, Set up a separate receivables account file for retainages in your general ledger. Okay. Control the collection of accounts receivable with the aging list as in figure 3.9. Builders who are in close contact with their customers may know quite well who owes them money, but an aging list can still provide needed information in written records of slow paying accounts. An aging list indicates what percentage of total receivables, excluding retainers, is current and what percentage is past due. Current is less than 30 days. Make sure to know what current means. It's less than 30 days. Okay, for moderate volume, some business owners like the pegboard system. Okay, verify your figures. This is how you get your current balance. Previous balance plus charge sale minus credits equals current balance. This isn't really that important. I don't think you'll see that on the test. And that's it for chapter 3. If you have any questions, please let me know down below. You can message me on WhatsApp or email me. And if you already signed up for another course and you're not liking the course, please message me. I'll work out a deal with you so you can get into a course that is actually going to help you pass the test. So yeah, thanks so much for watching, and see you guys in the next video. Peace. Okay, let's get into chapter 4, managing receivables. But your past experience is still your best indicator of the future. All right. The most common way to chart your accounts receivable trend is to calculate the number of days the average account is outstanding. An excellent way to keep tab on collection is to prepare an accounts receivable average length study as in figure 4.1. So here are the 3 important ratios you need to know how to do. You need to know how to plug in the numbers and how exactly to use these ratios, and how to know when they're asking for these ratios in a question. I go over this in the course on how to use these ratios, how to plug in the ratios, all examples, and then there's practice quizzes that have these ratios in there so you can give it a shot yourself. So the first ratio is period of average receivables. The second ratio is 12 months charge sales. And the third one is average days for outstanding receivables. Stay on top of existing accounts, but there's another important part of the receivables equation: prior qualification of new charge customers. Figure 4.2 is a credit application. Make it company policy not to extend credit unless there's an application on file. But when you assign an account to a collection agency, list it in a separate column in your accounts receivable analysis and exclude these figures from monthly totals. Okay. And then right here, another important thing, we kind of went over this in chapter 3. It may help to offer incentive discounts such as 2%, 10 days, net 30. That means the customer can deduct 2% from the invoice when payment is sent within 10 days of the billing date. This is a standard arrangement for shops that offer discounts, and it seems to bring payments in quickly. 99% chance this is on the test. In the course, I go over what a question would look like for this on the test and how to do it, how to do the math on it as well, because they're asking you to do math on it. And one thing I mentioned in the course, if they ask you in a question 10 days net 30, that means you need to know exactly what it means. That means the customer can deduct 2% from the invoice when payment is sent within 10 days of the billing date. There you go. That's why you need to know what 10 days net 30 is. I hope you guys liked today's video. Once again, if you want free 20 questions practice quiz for the Builder's Guide to Accounting, there's a link down below to get those free questions. And I will see you guys in the next video. Peace. Chapter 5. Bad debts can be a big profit drain on your business. When an account becomes uncollectible, you must reserve the income you record previously. To do this, you write off an account in both the general ledger and on the customer's account ledger. You could write off the accounts on the sales journal itself, but that's not what most accountants recommend. Generally, you should write off a bad debt only after exhausting all efforts to collect, but the rules change if you receive notification that the customer has filed for bankruptcy. At the point the law provides a procedure for filing a claim for payment. Further efforts at collection may violate federal law. Right here is very important. For tax purposes, bad debts can be recognized only when, read through that, the possibility of collection must be just about non-existent. Right here, setting up a reserve for bad debts has some important advantages. And then it goes over the advantage here. Read through that, super important. Here are 3 ratios that are super important that I go over the course on how to do them, how to plug in the numbers, everything you need to know about the ratios I go over in the course. So if you're not in the course yet, link down below, join the course. And then here are the 2 other, delinquent ratio and credit sales ratio. These 2 are very important. 99% chance see these on the test. So make sure you know how to plug in the numbers and use these ratios. And once again, in the course, I go over that, link down below. And right here is super important. Delinquent receivables are the amount due more than 30 days. Delinquent receivables are the amount due more than 30 days. Super important. Summaries like the bad debt trends reports are valuable because they support the financial statements required by your bank or bonding company. Read the information in figure 5.3 for January as follows. There is $1 of charge sales for every $1.14 of total sales. In the same month, $1 in accounts receivable was delinquent for every $6.90 of total receivables. We wrote off $1 in every $39 of credit sales. And last thing, the reserve for bad debts accounts is a reduction of your current assets and should appear in the general ledger immediately after the accounts receivable. So that's it for chapter 5. If you have any questions, you can message me on WhatsApp and you can use the link down below. Chapter 6, the only way to find out what jobs are making and losing money is to analyze your sale records by the type of work you do. Analyzing sales records. This is essential for cash budgeting, planning for future available funds. Okay. A high percentage of cash receipts generated from one place could indicate that moving into new areas might be dangerous, or it could mean that the builder is overly dependent on one small part of his total operation to support a large portion of his cash needs. To understand the significance of sales and their varying values and yields on investments you need, and then highlight these as well. Okay, and that's it for chapter 6. We're going to get into chapter 7 in the next video. If you have any questions, please message me. And if you guys want to join the course, link down below. Chapter 7, sales planning. The successful builder seeks profit, not simply volume, when taking on more work or looking for new lines of business. But the quality of your sales volume, not the amount, is the key to higher profits. Low profit volume never adds to growth of an operation. Instead, it saps income, ties up working capital and equipment, and demands time and energy that you could devote to more profitable projects. Analyzing the risk. If your volume remains the same, the commitment of additional time, money, and equipment means that the risk of a large loss grows greater. You should be aware of the increased risk before you commit yourself and your business. You can commit additional assets without increasing your risk if your volume grows proportionally to your assets. The bid, contracts, and materials sales category yield the minimum 5%, but account for 60% of the total volume. Okay, and that is going to be it for chapter 7. If you have any questions, please message me. And if you want to join the course, link down below. Chapter 8, planning for profits. It's wise to consider abandoning any part of your business that does not produce profits. The combined yield of a work A and B is 6.5%. Because work in the C area is losing money, it drags the total yield down to only 3%. Okay, nothing here. The relationship between volume and profit. It's important to understand the relationship between volume and profit. You should recognize this relationship when you decide to concentrate your efforts in one market and abandon another. The margin of profit increases with volume if costs and expenses are declining. Percentage of gross receipts. This is important right here. Make sure to highlight that and underline that. And then without that advantage, the profit margin will remain the same with increased volume or may even decrease. Selling expense usually rise in steps and are related to business volume. And that's it for chapter 8. If you have any questions, please let me know and I will answer them. Okay, now we're going to get into section 2 of the Builder's Guide to Accounting. We're going to go over chapter 9. So if you guys know, the Builder's Guide to Accounting it is set up as in sections. So you have section 1 is chapter 1 through 8, section 2, 9 through 19, and then section 3, 20 to the appendix and the index. So in my course, I actually break this down into 3 separate sections like they do in the book, so it's easier to understand. So now let's get into section 2, chapter 9, check writing and recording. You can't control your costs and expenses effectively if you don't follow good check writing and recording procedures. Okay, start by writing out complete names and description for each check and carry a balance of payments by account. This will support summary entries recorded elsewhere, aid you in balancing your bank account, give you detail needed for adjustments to accrue or defer costs and expenses, provide records for analysis and forecasting. The check stub and the canceled checks are supported by source documents. Here's the basic information you must record when you write a check regardless of the format of your check system. The check number, the date, who was paid, what the payment was for, or an account number, the amount of the check. Avoid math errors and bringing forward the balance by checking each page backwards for accuracy. From the bottom, add all checks and subtract all deposits, and then adjustments to make, highlight those as well here. The check register shows at a glance what expense categories you have and where your money goes. Prepare the register at least once a month. So they might ask you, how often should you prepare the check register? And it's at least once a month, right there. One major function of a check register is that it identifies math errors. This is called cross-footing. Writing checks to cash. Avoid writing checks made out to cash. Business deductions for checks made payable to cash are questionable and harder to prove than checks drawn to specific payee. Okay. This voucher checks. This was popular when a typewriter was the primary office tool. However, voucher checks like pegboard systems are becoming obsolete. Don't think you have to worry about that. The most efficient way to keep track of accounts payable on a monthly basis is to maintain 2 check registers, one for current month billings and another for previous month billings. Pretty important right there. Okay. Multiple businesses. The best accounting system for a builder who owns both businesses is to avoid transfers between the 2 operations except for periodic adjustments. Okay, and that's it for chapter 9. Chapter 10, this is a very important chapter. There'll be at least 3 questions on the quiz from this chapter, so I highly recommend paying attention in this highlighting guide. And I go over this chapter in my course. If you're interested in joining my course, link down below. So let's get right into it. Materials include everything you buy that will be installed on your jobs. Freight charges on that material are direct costs because they're a part of the cost of getting the material into the structure. Indirect costs are the expenses of taking a particular job that don't involve any work on the job itself. Indirect costs include freight, administrative, payroll, and small tools, and anything not billed to a specific customer. Overhead is the cost of the items you need to conduct business that you can't charge against a particular job. So understand these 2. That's because about half of your direct costs will be for material, and it's estimated that about 8 to 10% of labor costs on residential construction are spent just to move materials from the curb line to where they're installed. This right here, 99% chance will be on your test. So make sure to know where this is. I go over this in the course. Problems caused by sloppy material control, make sure to know that. Volume buying is a big part of good purchase planning. Controlling purchases. Written purchase orders are the most simple control device. Figure 10.1 shows a typical purchase order. A purchase order form should include the following information. Accounting copy to be matched to the invoice when received. Keep these in alphabetical order until bills are paid. Check the prices on the invoice against purchase ordered agreed prices. Okay. Summarize your purchase orders on a purchase journal so you can analyze total company material purchases at a glance for a given period. Some builders use the purchase journal as a source document for accounting entries, but if your purchasing system requires that you use a purchase journal as an accounting document, here is the entry you must make each month to record purchases. Controlling inventory. Controlling your inventory requires a purchasing plan that's in line with a strict inventory level policy. How much do you need to keep on hand and of what materials? Lack of planning and control can leave you with too much or too little material at any given time. All right, this page is important. 120 to 121. Valuing inventories. You will have this on your test, 99% chance. Inventories are usually valued on some types of cost basis. Since the methods used to report sales, profits, and yields are all based on an actual cost, job estimates are based on cost as well. So it's logical to maintain your inventories the same way. There are 3 cost basis valuation method worth considering. The right one for you depends primarily on the size of your average inventory. Read each one of these. In my course, I go over and explain each one because you need to know. This will for sure be on your test, 99% chance. There are 4 major inventory categories. They should be distinguished from each other since you may have to keep separate records unless all your materials fall into the first category. Read through these categories, understand which one they are. I go over this in my course as well. Analyzing materials and inventory. There are 2 principal ratios. One is the cost of goods sold to average inventories. The other is sales to inventories. The sales to inventories ratio isn't a precise indication of effectiveness because inventories are based on the cost of materials and sales are based on a computed cost plus profit. But you can use this ratio if sales are stable from month to month. Cost of goods sold to average inventories. The cost of goods sold represents all direct costs adjusted for the change in the inventory levels. Here's how to calculate it. Shown below are physical inventories based on the calendar year, but partnerships and corporations can base their physical inventories on the fiscal year. Since there are 4 possible types of inventories, there are 4 variations of ratios. Here's the ratios right here. A low ratio can mean that your average inventory is too high. A high ratio can mean that you're maintaining too small an inventory and may result in lost sales. Good inventory control does the following, and it goes over to page 122 as well. So that's chapter 10, a very important chapter. If you have any questions, you can text me or WhatsApp me. And if you're interested in joining the course, click the link down below. Okay, chapter 11. Labor is the largest and most variable cost in building. And then I have these highlighted right here, those bullet points. 4 ways to keep separate payroll records. Pay a bank or an independent data service center to prepare the payroll and provide backup reports. Issue payroll checks from the one general account and from the same check series. Checks in this account must be designed to handle payroll stub deductions. Use the general account for both payroll and other payments, but use a special style of check with its own numbering system for payroll. Enter payroll on the check register in the summary form. Set up a separate payroll account with its own check style used only for payroll. Nothing there. Nothing there. Accounting for tax liabilities. Okay, figure 1110 shows that a flow of funds through clearing accounts such as payroll taxes withheld on a gross payroll of $5,000. Withholding taxes are $1,521 for the current month. This amount includes the tax liability on behalf of the employees. Okay, this is an important section. This is also inside the contractor's manual as well, so we can go through it real quick. The federal government publishes several forms for payroll taxes. Be familiar with each of them and know how they apply to you. Form W-4 is the employer's withhold allowing certificate. Anytime there's a change in marital status, number of exemptions, or addresses, make sure the employee completes a new W-4. File Form W-2 wage and tax statement every January for each employee. That's important right there. Copy A. To the Social Security Administration, the W-2s for all employees are summarized on Form W-3. Transmittal of income and tax statements. Copy B, to the employee to file with his or her federal income tax return. Copy C, to the employee for his records. Copy D, kept by the employee for his records. Copy 1, to the state taxing agency summarized on the state version of Form W-3. Copy 2, to the employee to file with his state tax return. Use quarterly and annual forms to report wages and pay taxes. Form 941, employee's quarterly federal tax return. Form 940 is an annual report used to pay federal unemployment taxes. So I want to see if, like, in the contractor's manual, I can't remember if you can look up forms here and it will show you where to go. Let's see. Let me see here. Forms, yeah, it has forms, but it doesn't give you like the specific forms to go to, because if you go, let me pull out my contractor's manual real quick. If you go to the contractor's manual index, it will actually show you. Hopefully you guys can see that. There you go. Let me see if it shows at the under forms. If you go to F, it will show you the exact forms and what page. So like 940, 941, 944. It doesn't do that in the Builder's Guide to Accounting. I like to use, when I give it a form question, the contractor's manual. But you can find it here in the Builder's Guide to Accounting as well. Okay, last thing. Summarized below are the federal tax form most builders need for their payroll accounting. Form W-2, Form W-3, Form W-4, Form 8109, Form 508, Form 940, and Form 941. Some types of payments to include on your 1099 are dividends or interest over $10 in 1 year, and rents, commissions, and other types of miscellaneous income over $600. You pay someone other than your material suppliers. And that's going to be it for Chapter 11. If you guys have any questions, you can message me on WhatsApp, and you're interested in joining the course, the link is down below. Chapter 12, overhead expenses. Overhead expenses tend to remain fairly constant in spite of changes in your sales volume. There's a difference between labor, a direct cost, and union welfare expenses, a variable cost. Okay, this is important right here, this like little chart, this figure 12.1. You will most likely get a question on the test on this. I do go over this in my course with more information, but here they have variable expenses and fixed expenses. So they have variable overhead expenses, and they go over each one right here. And then they have fixed overhead expenses, and they go over each one here as well. This is super important. You should know where this is and how to understand it and everything. So read over this, and if you're interested to join the course where I explain this, link is down below. Goes over more here. Budgeting expenses. The budgeting process has 3 parts: preparing the budget, analyzing the results, taking action to control expenses. Another approach for variables would be to set budgeted amount for expenses based on assumptions about the level of sales or labor. Variable expenses right here again, and fixed expenses here again. Okay, this is kind of important right here. It's showing you the entry to record a prepayment such as insurance. So the prepaid asset, the debit, and then the cash is the credit. And then here it shows the entry to record each month's charge is insurance, the debit, and the prepaid asset, the credit. And this is important here as well. The cost of organizing a business can be high. The cost should not be charged against the first year of operation. Instead, you should set up in an asset account organizational expenses and write off the cost over a period of years. This process of spreading costs over a period of years is called amortization. It's handled like depreciation. You charge an amount to an expense category each month and reduce the assets by the same amounts. They go more over this in the next chapter, in chapter 13 as well, amortization. And that's everything for chapter 12. If you have any questions, you can message me on WhatsApp or text me. The number's right here. And if you guys are interested in joining the course, link down below. I'll see you guys in the next video. Now we're getting into chapter 13, equipment records. The largest single investment that most builders make is for equipment. You list your equipment on your balance sheet at its cost and depreciate it over its estimated life. The act of setting up an asset in the general ledger is called capitalizing. To take expense for a purchase over the life of an asset is to depreciate it. Fixed assets aren't actually fixed, so the term long-term asset is often used. This is more accurate because it describes an asset with a long, useful life. Long-term asset, let's explain what a long-term asset, and then a current asset as well. Current asset is less than 1 year. Long-term asset is over 1 year. Make sure you know that. Okay. The well-organized builder should have a defined plan for fixed assets. Classifying fixed assets. Your balance sheet should show enough details to reveal the true position of your business. And then right here, of what most builders should use to classify their fixed assets: office furniture and equipment, trucks and autos, machinery and equipment, small tools, building improvements, land. This is very important. All long-term assets except land are depreciated. Right there, very important. Unit cost for equipment. This requires certain information about each piece of equipment. Estimated average hours of use and idle time. And then it has more over here. This information will help you put together more accurate estimates and analyze project cost. All right, figure 13. 4, under distribution by jobs, record the amount of idle and repair time and useful activity. Depreciation, super important here. Depreciation is designed to let businesses recover the cost of buildings and equipment over the useful life of the property. And then they're going over the Marks Act right here. Very important, read through that. Modified Accelerated Cost Recovery System. You need to know what the Marks is. Okay, how to claim depreciation. There are several ways to claim depreciation. Under Marks rules, you may use a prescribed method or elect to use one of several straight line alternatives. But assets you begin depreciating under the rules can continue under the old method until depreciation or recovery has been completed. Questions you must ask before you begin to depreciate assets. Is the asset depreciable? You can't complain depreciation on land, inventory, or intangible property. Very important. And the Mark system dictates the depreciation periods you're allowed to use for each specific class of asset. The depreciation periods, called recovery periods, specify the time over which you can claim depreciation for that class of asset. We'll go over that. Straight line depreciation is a way to spread the cost of an asset evenly over its useful life. The same amount of depreciation is taken each year until the depreciable base is reduced to zero. This is very, very important. You need to know how to do straight line depreciation. It's one of the most important math problems on the exam. Right here, they're showing an example. I go over this in the course, step by step, how to do straight line depreciation. And also, they will have questions on the test about straight line depreciation that they don't talk about in the book. I go over them in my course so you know everything and you're well prepared for straight line depreciation. Declining balance depreciation. So this I go over in my course as well. You need to know how to do straight line depreciation and also declining balance depreciation. The most important one is straight line depreciation. You can probably pass the exam without learning declining balance depreciation, but we'll go over it real quick. To calculate declining balance depreciation, the first step is to calculate the straight line depreciation, ignoring any salvage value. So this is how you get it right here. You do straight line depreciation first. And then there are several percentages used with declining balance depreciation: 125%, 150%, or 200%. And then you do this one. And then right here, for the next year's depreciation, you will do this ratio right here. Once again, I go over all this in my course. Link down below to join the course. Okay, and I just wanted to show right here, if you look here at figure 13.9, it's showing you the difference. So on the test, they might ask you on year 3, under straight line depreciation or under declining balance depreciation, who had the biggest depreciation. So if you see on the third year, it looks like Straight Line had a bigger depreciation than 150% of declining balance and 125% of declining balance, because you have to remember Straight Line has the same amount of depreciation each year. Declining balance has a different rate of depreciation each year. And right here, where they were talking about the mark rules right here, the depreciation period called recovery periods specify the time over which you can claim depreciation for that class of asset. And it goes right under here, class lives under Mark's rules. And this is very important. You will probably see this on the test, so make sure to put a tab there or highlight this. You will probably see this on the test. I'm pretty sure I had the question right here for residential real property, including rental manufactured housing. Over what class do you depreciate it over? And it's 27.5 year class right there. And then right here, light trucks is 5 years, office furniture is 7 years. So they'll ask you like, under what class do you depreciate office furniture under the Marks rule? And it's 7 year class right there. Straight line is required for residential and non-residential real estate, but not for most other classes. Very important right there. You can make another important election to expense property placed into service in a year. That means you write off a lump sum instead of taking the deduction over a number of years. To qualify, you have to meet a few rules, and then here's the rules right there. Amortization, that's what I was talking about. Amortization spreads the cost of a major expense over time. Lease or buy, benefits if you lease. They might ask you a question like, why is it better to lease than to buy? And the most important thing right here is an immediate tax deduction is available for the cost of monthly leases. So you have an immediate tax deduction if you lease equipment. Read through this, it's super important. Under a lease purchase agreement, the full value of the equipment is included as an asset, and the full liability less equity is listed as payable, both currently and in the long term. Depreciation on the equipment can begin immediately as well. Sales and trade-ins. When equipment is sold, the books have to be cleared of all entries relating to that asset. Super important. The other part of this entry is to book the gain or loss on the asset. These aren't operating gains or losses, and they have to be kept separate from regular sales and gross profit. Otherwise, your comparison of operating results will be distorted. If a piece of $2,500 equipment depreciated to $7,000 is sold for $4,000, the loss in the sale is $3,000. Super important. Learn how to do this as well. I go over this in my course. So that is going to be it for chapter 13. If you have any questions, please put it in the comment section down below, or you can text my WhatsApp number as well. And if you guys want to join the course, the link is down below as well. Chapter 14, cash budgeting. Budgeting for cash requires an understanding of future needs, a clear plan for acquiring fixed assets, building inventories, and collecting receivables, and a strong set of cash controls. Cash flow problems are common to builders because the construction business requires large investments. Here's a list of what a good cash budget can accomplish right here. And then it goes over here on this page as well. When lenders examine your financial statements, they look closely at your recent cash flow. That's important right there. Testing the cash position. They're called liquidity tests and indicate the relative asset strength of a business. The first test is called the current ratio. Current means within 1 year. I have been saying this multiple times in all of my videos. What does current mean? It means within 1 year. But they say this multiple times in the contractor manual and the builder's guide to accounting. So make sure you understand what current means. Try instead to reduce your current liabilities rather than increase your current assets. The current ratio. One variation of the current ratio is so-called quick asset ratio, also known as the asset test. Inventory is excluded. Acceptance standard for the asset test is 1-to-1 or better, whereas the current ratio standard is 2-to-1 or better. The asset test recognizes the inventory can distort the test. Okay, preparing a cash budget. There are two principal ways to prepare a cash budget or forecast. the cash movement method, and the source and application of funds method. The cash movement method. The cash movement method involves budgeting only the flow of actual cash in and out of your business. This method is especially valuable for builders who have wide variations in their business volume from month to month. The source and application of fund methods. The source and application of funds method is more precise than the cash movement method. It assumes that you will attain a certain level of net income. Okay. Figuring a break-even point. You reach a break-even point when your profits fall to 0. Very important right there. This is important. This section right here is important. I actually go over this in my course for the break-even point. You need to know what the break-even point is. The break-even point has a very specific use. It doesn't distinguish between the various yields of the different jobs and job types you do. It can help you decide what kind of work you need to reach a volume goal. A break-even point doesn't encourage growth. It merely tells you the minimum sales you need to break even and serve as a reminder to maintain a strict cash budget to better that goal. Compute your break-even point one of two ways. Once again, read over this. And then, for example, on a volume of 150,000 with a direct cost of 60%, selling expense of 22.5%, and fixed overhead of 28,000, you will 100%, well, let me say 99% chance see this on your test, the break-even point. They might actually ask you to calculate a break-even point. So they'll give you, like, for example, the volume is 150,000. The direct cost is 70%, and the selling expense is 22.5%. And then you have to calculate what would be the break-even point. In my course, I actually go over this exactly so you know exactly what to do. They don't really explain this in the book that well. That's why I go over it in my course. So read this a few times. And if you're interested in joining the course, link down below so you can learn exactly how to do this. Okay, nothing here, nothing here. And that's going to be it for chapter 14. We'll get into chapter 15 now. If you guys have any questions, you can text the WhatsApp number and you can join the group chat here. If you're interested in joining the course or if you need free practice quizzes, link down below as well. Okay, chapter 15, costs and expense records. I don't have anything on the first page. Here on the second page, objectives of the cost system. Finding the best way to keep track of job costs and expenses isn't easy. Every builder's operation is unique and the right system is different for everyone. But knowing the objectives of cost systems should help you design procedures that will work well for you. A cost system should do the following: provide control of job costs, serve as a guide to future estimates, allow for varying labor rates, control material purchases and level of surplus inventory, judge the quality of job force productivity, analyze control problems unique to each job, identify overruns promptly so corrective action is possible. A procedure that tells you that you had cost overruns last month or even last year is of little value, but one that flags problems as they arise can be a real money saver, justifying the investment of time and effort required. General expenses which don't apply directly to jobs are allocated among the jobs in progress. You might get a question on the test for this, so check that. Okay. There's figure 15.3. Deferred income is neither a current nor a long-term liability. It's a deferred credit, a third distinct classification on the operations balance sheet. And last thing, direct costs should be carefully monitored and assigned to the proper job and regularly compared with the estimate that served as the basis for your original cost summary. Only by the following and comparing carefully can you expect to really control costs and identify trouble areas before they become disasters. All right, that's it for chapter 15. We'll get into chapter 16 now. Hey guys, we're getting into chapter 16 now. So first page, I don't have anything. Second page, I don't have anything. This is a short chapter. This is the only thing I have pretty much in this whole entire chapter. You can see. Oh, I have that one too. So accounting for overhead. You can't assign overhead to specific jobs the way you can payroll and materials. For this reason, you need some other reasonable basis to allocate these costs. In the meantime, overhead is a constant and recurring part of the job's cost. The only reasonable way to assign overhead in proportion to total direct labor hours, this can be justified by these factors. There you go. There's the factors right there. The most important factor is no other method of allocation comes as close to truly represent a fair distribution of overhead expenses as does relating them to total labor hours. All right, nothing here. And then the last thing here is the advantage of the job cost system is that completed contract accounts, which are actually not included in profit and loss, can be analyzed apart from the general ledger. That's it for chapter 16. Okay, now we're getting into chapter 17, petty cash funds. A far better alternative of either of these solutions is to use the Impress system. An Impress system accurately controls the flow of cash payments and documents them fully on your cash register. The Impress method has these advantages right there. And this is super important right here. Most operations need to keep at least $50 in petty cash, so they might ask you how much you need to keep in petty cash. It's $50. I have those. And that's it for chapter 17. Chapter 18, let's get right into it. If you guys have any questions, once again, you can text this number right here. And if you guys want to join the course, link down below. And if you guys want free practice quizzes, link down below. And we'll get right into chapter 18. Let's go. Okay, chapter 18, balancing the checking account. The only way to know your true cash balance at any time is to balance your checking account once a month when you post your monthly general ledger entries. The 10 steps to accurate reconciliations is 1, and then it goes over these right here. So I have deposits in transit, canceled checks, uncleared checks, outstanding checks, and deposits in transit are always adjustments to the bank balance right here. Okay, a checklist for balancing your account. I have those highlighted. Okay, and that's it for chapter 18. Chapter 19, accounting for estimates. Okay, the estimate. It's a good idea to have both field and office personnel analyze new jobs, then get regular status reports from your superintendent. You can watch direct costs from the office, but actual progress occurs at the job site. Instead, rely on educated guess and calculated averages to estimate your labor costs. Might ask you, how do you calculate your labor costs? Right there. This makes labor the single most difficult part of your costs and expenses to estimate. These percentages are approximate, but taxes, insurance, and benefits will add about 1/3 to your cost. So right here, what they're explaining is if you hire someone for $20 per hour, you're actually paying $26.99 per hour because you have to pay liability insurance, FICA, unemployment insurance federal, union benefits, and then workers' compensations insurance as well. So $20 turns into $26.99. I actually go over this in my course. If you're interested in joining the course, link is down below. And if you guys need a tutoring call with me, a one-on-one tutoring call with me, I recommend doing it before taking your test. We can go over anything you want. You can book that in the link down below. If you're not sure, prepare your estimates as though you'll be using a sub for each part of the job that you might possibly sub out. Allocating fixed overhead. Overhead costs must be allocated to each estimate you prepare. The best way to allocate overhead is on the basis of total labor hours. To allocate fixed overhead by direct labor hours, first use your estimate of the duration of the project. Next, figure what your annual overhead expenses will be. You should be fairly certain about how many direct worker hours the job requires. You should also know your annual fixed overhead. The next step requires an approximation. Okay, nothing on there. And now we'll get into chapter 20. This kind of goes over debits and credits. We'll go through it pretty quickly. Accrual and deferral entries record real events, exchanges of money that have not yet taken place or that occurred previously and are being spread over time for accounting purposes. Recording before the event is a way of equalizing timing differences between work you do and payment you expect to receive later. Your accruals should reflect the true financial condition of your business, regardless of the timing of cash exchange. Percentage of completion adjustments. There are roughly 4 types of accruals you're likely to make using this accounting method. They can be defined by top of entry. You'll need to report income not yet paid but reported under this method, defer income received but not yet reported, accrue costs applicable to currently reported income levels, and defer costs paid for but not yet reported. So this is what I was talking about. They kind of go over the debits and credits here, and then on the next page as well, debits and credits, all of them pretty much. So accounts receivable, all sales on accounts should be accrued because no cash changes hands. Pretty important right there. If this entry could be isolated from sales, it would look like this. This kind of, in my course, I kind of go over debits and credit from the contractor manual. I feel like it's easier to understand when you're doing the contractor manual debits and credits. They do a better explanation of this. If you're interested in joining the course, the link is down below. I go over everything so you can pass on your first try. And if you just need to buy practice quizzes, if you're studying for the exam, you can buy them in the link down below. I have those available, and I also do one-on-one tutoring calls. If you're interested, it is linked down below. So back to prepaid expenses. You don't usually pay all your expenses in the current month. You can accrue them for payment in later months, and some of the expenses do apply to more than a single month's service. You may pay 3 years insurance coverage in advance. For instance, in the first month of the policy period, it would not be accurate to record the entire 36 months expense in the first month. The entire amount should be classified as a prepaid asset and assigned to an expense account. Reserve this procedure for expenses that apply over 12 months or more, apply for less than 12 months, but belong partly in the following tax year. And then once again, they're going over the debits and credits here. Okay, right there again. Prepaid expenses and depreciation. Amortizing an expense over a period of time is not all the same thing as depreciation, although the two seem similar at first glance. Deferred asset. You can treat expenses by paying them and deferring them in your books until a later time. Unlike prepaid asset accounts, which recognize expenses by amortizing them over time, deferred asset accounts are set up for payments you make now that will be recognized at a later date. The security deposit is refundable and should be placed in an asset account. Pretty important. Controls. Know at any time exactly what items are in prepaid assets, deferred liabilities, and provision for future losses accounts. The cash account method. The other method of accounting is called the cash method. In this method, as we have seen in earlier chapters, you only record exchanges of cash and financial statements, show only cash exchanges. You can use this method for income tax return, but only if you do so every year. All right, that's going to be it for this chapter. Okay, now we're getting into chapter 21. Pretty important chapter and long chapter, so let's get into it. There are 3 distinct financial statements. Each one serve as specific function. The balance sheet, the income statement, the statement of cash flows. The balance sheet. The balance sheet is a summary of the existing conditions of the business. It's called a balance sheet because its line-by-line details show the balance of general ledger accounts. The balance sheet lists the assets, liabilities, and net worth of a business as of a given date. Right here, assets minus liabilities equals net worth. You've probably seen this multiple times. It's in the beginning of the Builder's Guide to Accounting and also in the Contractor's Manual. Super important ratio. The income statement. The income statement summarizes business operations within a time period. So if they ask you, what statement summarizes business operations within a time period? The income statement is broken down into more or less standard divisions right here. The statement of cash flow. The statement of cash flow is a summary of the sources of and use of cash where it came from and where it went for the same period covered by the income statement. The statement of cash flow has two sections: the fixed or long-term provision of funds, which includes net income, the change in current assets and liabilities. Balancing financial statement relationships, the balance sheet, the income statement, the statements of cash flow, right there. Okay, the trial balance. After you post your ledger at the closure of the period, the first step is preparing financial statements, is to put together a trial balance. Closing adjustments. Here are some typical adjusting entries right here. Okay, it goes over 9 through 10 here too. Balance sheet accounts, current assets. Current assets are liquid assets, assets available to the builder within 1 year. I always say this in all my videos, you gotta know what current means. Current means within 1 year. This means that they could be turned quickly into cash. The asset accounts include cash, accounts receivable, inventories, and other current assets. Fixed assets. This account category includes the gross value of equipment and machinery, small tools, improvement, furniture, fixtures, structures, and land, less a reserve for the depreciation that you've expensed for them. These assets are fixed because they aren't available to be turned into cash within 1 year. Other assets, goodwill is an example of an intangible asset. The seller of a business often adds a goodwill value to fixed assets, inventory, and other tangibles. Convenient not to compete. Goodwill can't be amortized or depreciated, and it remains at its original value indefinitely. Current liabilities. Like current assets, which are liquid and convertible within 1 year, current liabilities are payable within 1 year. Long-term liabilities. The most common type of long-term liability is a long-term note or a contract payable. Other liabilities. Long-term liabilities will eventually become current liabilities, but deferred credits are likely to be clearing or wash items that enter this account and are soon cleared back out again. Contingent liability. A possible debt from a pending lawsuit or a potential unrecoverable loss are example of contingent liabilities. Equity account. Partnerships have an account called partners equity, while corporations have an account called capital stock. Amounts withdrawn, called draws, are deducted from profits. This provides a yearly running balance of each partner's investment balance in the company. Okay. Retained earnings. Corporations have a retained earnings account in addition to a capital stock account. Once the corporation is operating, each year's profits, losses end up in this account. Net profit. This account may be called a retained earnings account, corporations, or an equity account, partnerships. Direct costs. It's important to distinguish direct costs from operating expenses. Find the gross profit figure, a significant indicator on income statements, by subtracting direct costs from net sales. Operating expenses include in this account all indirect expenses. Tax provisions. This account category should include federal, state, and local taxes, even if you haven't paid or deposited the amount yet. Statements of cash flow categories. Changes in long-term assets and liabilities and capital accounts. The change from the end of the previous period to the current period is shown in detail by type of change. These changes include two major divisions: source and application of funds. Sources include, and then applications include. Their summary of net changes in working capital. The second section of this report is a summary of net changes for the period in your working capital. The term working capital refers to the net difference between current assets and current liabilities. Footnotes to financial statements. The final section worth discussing is the footnotes to financial statements. These can be brief or highly detailed. While the tendency is to view footnotes as not very important, that's not the case here. They should always be read with great care, as many items affecting financial strength won't be reported on the financial statements, but could be noted in the footnotes. All right, that's it for chapter 21. We'll begin into chapter 22 now. Okay, chapter 22, using financial information. But applying financial statements to current conditions and managing your operations with long and short-term goals in mind are just as vital to growing a healthy business. Profits isn't an indicator of cash flow control. It merely shows the yield on sales volume. Several factors could contribute to absorbing the builder's $20,000 profit. Right here, an increase in outstanding accounts receivable, a decrease in accounts payable, heavy commitments to payments of notes, purchase of new equipment, partnership withdrawals in excess of profit. Financial statements can also help plan for debt repayments, for new financing, and for the uses of other loans. Standards are basic budgets. You need standards to increase building volume, the type of quality of that volume, and the expected yield from it. There are 4 major areas in which standards must be set. There's the 4 major areas here. And ask yourself the following questions when you evaluate which plans to enforce and which plans to scrap as out of date, right there as well. Sorry if I'm not going directly into detail about this information. In my opinion, I didn't really see any of this on my exam, and it's stuff you don't need to know, but I do have it highlighted just in case it did come up on the exam, because once again, they can ask you any questions that are in these books. Okay, using financial information. Financial data must be acted on to be effective. From it, you should be able to direct sales efforts, control costs and expenses, and plan profits. Get around this problem by analyzing your cash flow as often as necessary. Goals of 1 year or less are what budgeting is all about. Okay, that is it for that chapter. Okay, chapter 23, financial ratios. Here are the 3 most common expressions of ratio relationships, right there. Ratios can be used 2 ways: to indicate a single business condition and to indicate a trend. The current ratio, for example, is used universally to measure a company's ability to meet current obligations from current assets. A 2-to-1 current ratio is the minimum current asset to current liabilities considered healthy for a business. Balance sheet ratio, the current ratio. A 2-to-1 current ratio is considered the satisfactory minimum, and that's how you get the current ratio. I go over this in my course. I go over pretty much all the ratios you really need to know for the exam in the course. If you're interested in joining the course, it is linked down below, and you can text this number here if you have any questions as well. The quick asset ratio. The quick asset ratio, or the asset test as it's sometimes called, is similar to the current ratio. It's also expressed as X to 1 and is calculated using the same accounts as the current ratio right here. A minimum of 1 to 1 is considered healthy for the quick asset ratio. Compute the ratio as follows right here. Current assets without inventories, current liabilities, and quick equals your quick asset ratio. I go over that in the course. It also indicates whether a business is heavily dependent on outside funding. It is expressed as working capital divided by funded debt. Okay, nothing here. A list of common ratios. I go over this in my course. This is like a little cheat sheet right here. If you get a question on how do you calculate working capital, it's current asset minus current liabilities. How do you get margin profit? Net income divided by sales. So yeah, and that's pretty much it for this chapter. So we'll get into chapter 24 in the next video. Okay, chapter 24, putting together a statement. Accounting coding. The most common headache for builders and their bookkeeper is coding accounts properly. The general ledger is nothing more than a summary of your business activities. Remember the following points when you make entries in the general ledger. Okay, chapter 25. This is a short chapter. I think I have 3 things highlighted on here. This is the only things I pretty much have highlighting. Other comparative applications. Comparative analysis has applications throughout your books and records. Comparative cash flow statements can be prepared to discover increases or decreases in cash efficiency. Comparison with budgets. You may want to compare actual results to budget expectations. This type of comparative statement has 3 columns, each for a different set of figures. Actual results, budgeted amounts, variance from budgeted amounts over or under. And that's it for chapter 25. Pretty short chapter. General ledger posting. The general ledger is broken down into the following main categories. This is important right here. Okay. Here are some of the common posting errors. The trial balance. The next step after posting the general ledger is to test the balance because all entries in the double entry method consist of equal debts and credits. The sum of all accounts in the correctly maintained general ledger will equal 0. Adjusting the trial balance. Accounts balance must be adjusted when you prepare the financial statements. And then I have those highlighted right here. And right here as well. Okay, here we go. Closing the books. The books are closed at the end of each year. Super important right there. One of the books closed at the end of each year. This means that the final adjustments are made to up all the accounts and they're recorded in the general ledger. Then all income, costs, and expense accounts are closed out. The following net worth accounts are commonly found in the general ledger itself. Capital stock accounts, partners equity accounts, partners draw accounts, retained earnings, profit, loss. Partners equity accounts are owners equity accounts for sole proprietorship. Receive their share of all profits, otherwise called retained earnings, at the close of each year. And that's it for this chapter. Get into chapter 25 in the next video. Chapter 26, restatements by accounting method. The restated income statement. Analyze your financial statements occasionally by examining results using both methods. That way you can judge profits realistically by seeing how well you're doing when some of your profits are deferred. And I think that's all I have for this chapter. So now we'll get into chapter 27. Chapter 27, statements by job. Begin your by job breakdown with a detailed income statement. Remember the following rules by breaking down income and expense data by job. And then right here I have the 1, and 2. And then on a detailed income statement, break down all income producing areas into job categories. Here are some typical categories, and then 1 through 5. And then I have here plotting job progress. But remember that most profits are produced in the middle part of the job. If the curve of actual profits starts upward too early in the job schedule, it indicates several possibilities. You might finish early, make a higher overall job profit, need to reschedule labor and materials for earlier dates, need to examine the estimate to determine why you were off. But if the profit doesn't swing up soon enough or fast enough, it can mean that you will finish late, make a lower overall job profit, need to delay scheduled labor and materials until later in the job, need to examine the estimate and the actual supervision of the job to determine why the job is off schedule. Long-range job planning. But here's a list of factors that affect your ability to do various kinds of work. Right here, personality, capital, management, ability, workforce, competition. Levels of control and job planning. These controls have to be enforced. Idle time must be kept to a minimum by careful daily scheduling. Receivables must be kept collectible through vigorous collection procedure. Inventory levels must be kept reasonably. Faced with unacceptable low profits on some of your regular jobs, you can take one of the 3 actions. There's the 3 actions right there. And that is going to be it for this chapter. We're getting into chapter 28 now. Chapter 28, statements for loan applications. You're buying money when you take out a loan. Your payments are broken down into 2 parts: principal, or the money borrowed; interest, the cost of borrowing the money. I think we pretty much all know that. Loan as investments. For a builder to get a loan, you must do more than show the lender you're the best craftsman in town. You must convince the bank that you can control costs and expenses, produce a profit, pay back the loan with minimum strain, and maintain a healthy business status with the proceeds from the loan. Here are some of the personal and business characteristics you must be able to demonstrate to the bank if you want to consider it a good risk. Right there, read through those. Loan applications. Most bankers require all
or most of the following information in the application package: the loan application form, an income statement for 1 full year, a current balance sheet, a cash flow projection for 1 year, a federal income tax return for the previous year. Small Business Administration. The Small Business Administration is a government agency originally formed to help small business owners by offering a loan guarantee. The SBA isn't in the primary business of lending money to businesses. It most often works with small businesses owners to find loans in their communities and guarantee repayment on behalf of the business. Right here, the SBA is valuable resources for small businesses ventures. By SBA definition, a small construction firm has annual sales up to 17 million and fewer than 100 employees. SBA doesn't make the loans itself, rather they work with the local lenders who grant the loans. We got one more. The most prospectus format, on the other hand, is a simple 3 or 4 page summary of the company's markets and history. And that's going to be it. Now we're going to get into the appendix.
If you have any questions, you can text this number here. If you guys want free test, link down below. And if you guys want to join the course, link down below. I don't really think the appendix is that very important. I don't think I had one question on the test in the appendix, but I have a few things highlighted that I want to go over with you. So let's get right into it.
Okay, the chart of accounts. The first step toward designing a chart of accounts is to define the broad classification of the general ledger. Those are there 1 through 9. Okay, I have chart of accounts here. This is all the chart of accounts. I have reserve for bad debts highlighted. Okay, Appendix B. Don't think I have anything here. Appendix C. Following are some examples of accounting transactions you'll likely encounter and the steps they'll follow on the way to final posting in your general ledger. Okay, research before you buy. There are 4 attributes to look for in a good software system. There. Appendix D now is income tax planning, reducing your taxes. Techniques used to minimize tax include shifting, conversion, deferral, and sheltering. Shifting. If you expect a greater tax burden this year than next, you should shift income to the following year and increase expenses this year. Conversion. Now it's no longer possible to convert ordinary gains to long-term capital gains. Deferral. You can defer taxes in several ways. One is to use the completed contract accounting method to the extent allowed under the law. Sheltering. You can shelter part of your income as a self-employed contractor if you set up a Kyogi plan. Here's a summary of tax saving ideas 1 through 5. And that is going to be it for the Builder's Guide to Accounting. If you guys have any questions, you can always text this number right here. And if you guys are interested in joining the course, the link is down below. And I have a free Builder's Guide to Accounting test that you can get linked down below. And if you want to join a tutoring call with me, a 1-hour tutoring call, there's a link down below to schedule a tutoring call with me. And once again, always join the WhatsApp study group. You can text this number. You can ask me any questions at this number here. So yeah, I hope you guys liked today's video, and I'll see you guys in the next video.